Joining us to discuss the credit market revival is Mark Bamford, head of Global Fixed Income Syndicate at Barclays Capital, the #1 underwriter of global debt, according to Bloomberg data. Mark, let's talk about this spate of corporate bond issuance. We've actually seen more than $1 trillion worth of corporate bonds sold here in the U.S. We're coming up on $2 trillion in Europe. How much longer can this continue, given the fact that so much new supply is coming to market?
Good morning, Erik. Yeah, you're right. It's been an extraordinary 9 months year to date. As to how long it can go on, I think it's going to go on for a while. And I think the primary reason for that from the issuer standpoint is that issuers are going to move from reliance on bank debt, bank loans, revolvers, to putting that debt into the capital markets. And that's what we've seen this year, and I think we're going to see that for years to come. And to your point about demand, is there investor demand for all this supply? The answer is yes. Investors all year have shown up for a variety of offerings. In Europe and the U.S., we've seen order books, particularly of late, many times oversubscribed. So we've got plenty of supply to come, and we've got plenty of demand as well.
Aren't they going to get full, so to speak, at a certain point, though? You know, there wasn't as much corporate issuance in the third and fourth quarter of last year, and it was still pretty slow through the first quarter of this year. But at a certain point, aren't investors going to get tapped out? And I guess as well, attached to that, what if spreads start to back up?
Yeah, you raise an interesting question, which is at what point do investors say, I've got enough? And I think what we're seeing now, and the difference in the market today versus, say, the first quarter of this year, is that investors are much more focused on deal by deal, which is to say certain asset classes have run a very long way, spreads have come in a very long way, and deals are more specific in terms of their success based on where spreads are. So I'd say investors are much more focused on spread right now than they were earlier in the year.
Let's talk about the securitization market, because everybody remembers what happened with CDOs, especially the ones that were backed by subprime mortgages. They blew up, pulled us into the credit crisis, and CDO issuance has all but disappeared. How healthy really is the securitization market? How much of it is dependent on help from, say, the Fed and the TALF program?
Right. It's interesting. The securitization market has picked up dramatically, particularly in the third quarter, but also in the second quarter. There's been about $100 billion of issuance in the U.S. market, and most of that has happened in the second and third quarters of this year. It's a healthy market in that investors are looking for transparency in the assets that they buy. So, for example, that the deals you're seeing today are credit card transactions, prime auto loan transactions, dealer wholesale transactions. So they're very specific assets as opposed to CDOs, where you were buying a broad array of assets. These are very specific. Investors are getting a high degree of comfort in the asset that they're buying, and they're buying them at spreads that are, even though the market's rallied a lot in the last couple of months, they're still buying them at very attractive spreads.
So, Mark, if you were going to judge the health, I mean, are we ever going to go back to 2007 levels, for example?
I don't think so. I think when you look at the difference in the market in 2007, volume, and what's going on now, the difference is the deals that are getting done now, again, they're very specific. They're very asset specific. And I think that's the securitization market we're going to be in for a long period of time, which is to say investors want to know the issuer, and they want to know the specific asset class that they're buying, as opposed to a very broad array of assets that rely on a rating as opposed to a specific asset. So I think we're in a new world. I think it's going to be a lower amount of volume for the next couple of years, but they're assets that investors understand very well.